the main profitability ratios. So we'll just start, or we'll continue in that line. We're talking about profitability ratios used by investors, management, and analysts to gauge business performance and compare with competitors and make financial decisions. So that's the first profitability, or the first ratio type we'll be looking at. We'll be looking at 5 of them, but profitability comes first because it's a ratio that has to assess performance of the entity for that particular period. And is one of the main ratios the examiner tests very concurrently in his exams or in the diets. If you look at it very practically, he always tests profitability ratios. So the first one we'll be looking at is return on capital employed. Return on capital employed, which is the general rules. It expresses a business entity's profit as a percentage of the amount of capital invested in the entity. So capital has been invested by either debt, external providers of capital, or equity, internal providers of capital. So this amount invested has to yield returns, especially on a yearly basis. So the returns is what we are looking at after capital have been injected or provided or employed in the business. So the formula is clear on the screen. Profit before interest, long-term interest, and tax. The denominator is your share capital, reserves, including non-current liabilities. So why are you looking at profit before interest and tax? We'll be looking at that subsequently. So PBIT divided by your share capital, reserves, and non-current liabilities, or profit before interest and tax divided by net asset. Net asset looking at your total assets less either your current liabilities or your total liabilities. We'll be looking at those definitions subsequently. Okay, so net asset, we look at total asset less current liabilities. Some examiners allow total asset less total liabilities, but the main definition, even if you use any of those denominators, total asset less current liabilities or total asset less total liabilities, you will not be penalized. Why the long-term liabilities is exempted is because of the profit before interest and tax you are using, because of the long-term nature of the debt. And that is why current liabilities is deducted mostly in these calculations during exam or under exam condition. So the rules can also be broken down into subsidiary components where you look at the profit before interest and tax divided by sales, which is your revenue, times your revenue divided by your profit before interest and tax. So if you cross multiply, you cancel out the sales, you see that your profit before interest and tax is divided by your net sales or net assets. All right, so what does this mean? It indicates that the company is generating more capital it has employed in the business. Okay, so let's calculate the profit after tax, or let's calculate the return on capital employed of this Dan Kabir. If you can see my screen, I shared the question with you. Dan Kabir is an FMCG in the pharmaceutical industry, and it's a 3-year financial statement summary, including the statement of comprehensive income, statement of financial position, and statement of cash flow. So it's a tripartite financial statement, just like the examiner provides. It's just that he has not tested cash flow statement so far. So we'll be looking at the cash flow statement inclusive of this financial statement. The examiner so far in his 21 diets that has come and gone, he has always tested the statement of comprehensive income and the statement of financial position. He has not tested cash flow yet. So I provided cash flow in case in May 2025, he provides a cash flow statement. And there are some ratios, 1 or 2, that relates to the cash flow statements. So we are conversant with its calculation and how to go about it. Okay, so looking at the return on capital employed formula, I'll be toggling my screen. I'll be going between the financial statements and also the PowerPoint where our formula is. Okay, so on the screen, you can see the formula, profit before interest and tax. So we'll calculate using the profit before interest and tax formula with the denominator as share capital reserves plus non-current liabilities. And we can also calculate profit before interest and tax using the net assets. So we use the two variants and see what percentage it gives us. Okay, so back to Ankabir. We go to our profit before interest and tax, which is in the SCI. Now in the SCI, we have our revenue, and we have the cost of sales, we have gross profits. We have the indirect expenses, and we have the profit before depreciation and amortization, which is 132 million. Don't forget you have your amounts in thousand here. So everything you have is in thousand here, 000. To take note of that under exam condition. Okay, so our profit before depreciation and amortization is 132 million. But then it's tricky. We have to get profit before interest and tax. So take note of that. We are working towards profit before interest and tax. So our profit before finance cost and tax is 104. So we'll take our profit before finance cost. So I'll be using Excel for the calculation because I don't have a pen and paper. So just follow me closely and as we work on this. So if you can see my screen, I'm using Excel. It's just plus and minus. So you have your calculator, you have your notes. So just use it to follow through. Okay, so this is for, let's do for this first year, which is 2020, 31st December 2020. So let's pick our profit before finance cost, and tax. That's for 2020. So that's about 104,500,000. So that's what we took to our Excel and we posted it here. So let's say this is for 2020. So let's take this and put for 2021. And we take for this and put for 2022. All right. Just want to reduce the font a bit. Okay, so that we can capture the trace. All right, fantastic. Okay, so we have our profit before finance and finance costs. Let me reduce that also. Good. All right, so I've reduced the font a bit so that we can see the figures and how it aligns. Okay, so profit before finance cost for 2020 is 104,500. That's 104,500,000. Now, going back to the question, don't forget the profit before finance cost and tax, or profit before interest and tax, is before depreciation and amortization. So we are going to add back depreciation and amortization. So let's pick our depreciation and amortization figure and add it back to our profit before interest and tax. So take note of that under exam condition. We are adding back our depreciation and amortization because we've not come to the deduction of those items in the financial statement, especially for the calculation of the return on capital employed. So our profit before interest and taxes is the addition of these three variables, which gives us 132 million. Please, you can interject if you have any question. Please feel free to interject as we are doing this calculation. If you have any question, just stop me and I'll clarify. Okay, so for 2020, we have the profit before interest and taxes as 132 million naira. 132 million naira. Very simple. Okay, so from the formula, you'll see that our share capital, inclusive of reserved plus non-current liabilities, is the denominator. So let's go to the question to our SFP and pick that. So you can see our SFP on the screen. Our share capital for 2020, we have January 1st and we have 31st December. So we are using 31st December, the ending of the financial year. So take note of that. Be very careful when you look at questions like this so that under exam condition, you don't go and take the beginning of the year. So take note of the ending of the year and the beginning of the year. There's a reason the examiner might tweak that to get you off balance. So please take note of that. Okay, so we go to our equity position where we have the share capital at the beginning and at the ending. So we have share capital 210. Then we have share premium 105. We have retained earnings, which is also reserves 630. Take note of that. We are not going to add preference share capital because that is a special debt. So we are not looking at preference share capital in the calculation of profit before return on capital employed. So we look at the share capital, share premium, which is a reserve. Retained earnings is also a reserve. Then we take non-current liability. So we take bank loan, take bonds payable, and we take deferred liability, deferred tax liability. Okay, so I pick these three. Just pick it to our calculation. Okay, I can see Julie's hand up. Julie, please, please go ahead.
Yeah, I noticed that you didn't include preference shares. It's not part of the share capital.
Yes, thank you. I know somebody will ask that question. Thanks for asking that. So preference share capital is a special debt. It doesn't belong to the ordinary shareholders of the company. So if you look at our formula states profit before interest and tax, then share capital plus reserves plus non-current liability. Why didn't they include preference share capital? Is because they have a fixed amount on the profit or the dividend of the company. They have a fixed amount on the dividend, so you don't include them in the calculation of return on capital employed.
Yes, thank you.
All right, you're welcome. So that's the reason why we are not including them. Okay, so our share capital is 210, our share premium is 105, and our retained earnings is 630. So let's go take our non-current liability from the question. So our non-current liability, we have bank loan 315, we have bonds payable 157. So we'll take that also. And I know somebody will ask, why are we not taking deferred tax liability? I will explain that shortly. We are not taking deferred tax liability to calculate the return on capital employed. I will explain that and why we are not doing that. Okay, so we have a total of 1,417,500. So let me calculate that. We have 1,417. So this is our share capital, reserves, and non-current liability. So we have this as 1,417,500. So if you go back to the question, you see there's deferred tax liability in non-current liability. So why are we not adding deferred tax liability of 52,500,000? It's because deferred tax is not a debt. You did not incur the debt by an external loan or an external provider of capital. it's a commitment or an obligation to government. So you have to include only the commitments to those you borrowed funds. So bank loan is a borrowed amount. Bonds payable is a borrowed amount. But deferred tax liability is a tax you're supposed to pay, but you've not paid it, so you deferred it. So it is not a debt per se. It is a liability owed to the government. And that is why in the calculation of profit before return on capital employed, you don't add deferred tax liability. So take note of that, because you may see such scenarios in the main exam that will tweak or confuse you. So take note of that. All right. So let's calculate our return on capital employed. So we have our profit before interest and taxes divided by our share capital, reserves, and non-current liabilities. And we have the percentage as 9%. So our profit before interest and taxes divided by the return on capital employed is 9%. So if you use your calculator, you will see that 132 divided by 1417500 is 9%. So I would like us to do that of 2021 so that we can engage on 2022. So I would suggest, let me see who is going to take 2021 and 2022. Let me go back and toggle the screen and put it on the question of Dan Kabir. So let's calculate that of 2021 and 2022, your profit before interest and taxes. First, before your share capital and reserves. Okay, before we do that, let me take the second variant, which is public before interest and taxes, and we have the denominator as net asset. Let me do that before we do 2021. So let's look at how the result of this will be. So let me open another sheet for this and move it for the calculation. Okay, so we already have our profit before interest and tax. So I'll just remove the denominator. So I've left the profit before interest and tax. So let's do our net assets. So our net assets based on the formula is total assets less current liabilities, which is also capital employed. Total assets less current liabilities. Okay, so let's pick our total assets now. From the question, what is our total assets? Our total assets from the question is, at the end of the year, is 1674750. So I take that to my Excel. So I have total assets of 1674. Then let's go pick our current liabilities and deduct it from the total assets. So our current liabilities is 420 million. Total current liabilities, as you can see on the screen. Please interject if you have a challenge with these calculations. Interject, be free to interject. Okay, so our net assets is our total assets minus our current liabilities. So we have it as 1,254,750,000. Our net assets. So let's calculate our return on capital employed since we have our net assets and see if it's almost the same with what we calculated in the other rows. And just rename this. All right. So we have our profit profit before interest and taxes divided by our net assets. And we have a total of 11%. So the variation between these is 9% and we have 11%. So the variation is just 2%, it's not much, which is our return on capital employed. Okay, so for the first one and the second one, can we do it? Is it possible? We have our calculators. Can we do it quickly for 2021 and 2022 if you understand the computation we just did? So I would hold on for us to do it. Is that possible?
Yes, we can try. Yes.
Okay, fantastic. Fantastic.
This last
Okay.
question.
Okay, sorry.
Question, right?
Rufi. Okay, sorry. Sorry, ACA Zakaria. Let me take Rufi first. Let's go for Rufi first before you go.
Okay,
all right.
Okay.
Yeah. All right, Rufi, let's go. Let's hear you.
All right, sir. Thank you, sir. I have an observation. I've come across some calculations where they kind of use the average of the capital employed. What's the difference between using the average and you just using the exact figure? Thank you, sir.
Okay, nice question. So the average of the capital employed is not really a return on capital employed calculation. So where you are using average of the capital employed, you are saying maybe you have the first year and the second year and you divide it by 2. That's wrong for calculation of return on capital employed. So the average comes only when you are calculating maybe activity ratio. So coming across any textbook that does average of return of capital employed, looking at maybe 2020 and 2021 divided by 2 is a wrong approach, except where the examiner expressly says you should use the average as the denominator. Then please go ahead. But the standard computation or the standard formula for return on capital employed is not the average, is the total asset less current liabilities. Some other textbook you may see total asset less total liabilities is also allowed, but the main computation is your profit before interest and taxes divided by the capital employed, where you have the equity and the debt as the capital. I hope that clarifies your question.
Yeah. Thank you for the clarification. Thank you, sir.
You're welcome. Okay, let's take ACA Zakaria. Zakaria, please go ahead.
I was asking what
Good evening, sir.
okay, I was asking
good
what your
evening.
question we're working on.
Oh, okay. Sorry, Salmat. Can we give Zakaria the floor? You will speak after him. Sorry. Okay, Zakaria, please go ahead. Salmat.
Sir, please, when did you drop this question?
I dropped it in the morning, since morning. I also dropped it this evening. It's on the chat box.
Okay, today.
Yes, today. Yes, it was dropped in the morning, and it's also on the chat box.
Maybe that's why I didn't notice. So it's okay, sir.
Oh yeah. You can just go to the WhatsApp platform. You'll see it on the chat box.
Okay.
Yeah. All right. Is that your only question?
Yeah, yes, sir. Yes.
Okay. Let's go to Salma, then we'll come to Julie. All right, Salma, please go ahead. Let's hear your thoughts.
Yes, I had the same question. I'll just be going. I had the same question with his own. I was looking for yes. I thought when I saw Dan Kabir, I thought it was November diet last year, so I was tracking my question and the numbers were not aligning.
Oh, okay. No. Dan Kabir, I just picked it as the name. It's a different financials totally.
Yes, thank you.
All right, you're welcome. Okay, so Julie, let's hear you. Please go ahead.
Yeah, in your calculation 2020 and from the table as well, they already gave us the figure for profit before interest and tax. So I'm wondering why you had to calculate it again when they had already done that.
Fantastic, good question. That means you are very observant. I expected that question. Okay, so if you look at the normal statement of financial position, IFRS compliant format, now the first thing you have is revenue, then you have cost of sales. After cost of sales, you have gross profit. After gross profit, you have your indirect expense, which has to do with admin and distribution. Now, the normal IFRS does not have depreciation and amortization first. That is why you have to add it back. Depreciation and amortization is an inorganic expense that you have to, how will I put it now? It's not a cash movement. But you see, finance cost comes before the depreciation and amortization, then the tax. So you are adding it back because you don't deduct it before your finance cost and the finance income. That's the essence. So where you have profit before interest and taxes. So take note of it. The examiner can peep it in a way, and you can just come and say profit before tax. You are wrong because it doesn't come before the deduction of depreciation and amortization. You have to add back depreciation and amortization. So it's tricky, and I deliberately did that, and you captured that question. Is a very good one. So under exam condition, please add back depreciation and amortization to get your profit before interest and tax. 4 rules. Thank you for that question, Julie. It's a nice one.
Oh, but it's already there. Why didn't you just pick it?
Yeah, so why I didn't pick it is because the depreciation and amortization has been deducted. So 93,500 is not the actual amount for your profit before interest and taxes.
I'm talking about 2020. I'm looking at, we could have just picked, from a calculation, profit before amortization and depreciation is 132,000, which you calculated. So, I mean.
Okay, on the, yes, on the table. Question here, right? Yes, on the table. So why did I walk? Good. So why did I walk back? It's so that you can, under exam condition, not just pick a figure and get wrong. So it's possible you see profit, yes, under exam condition, yes. Yes,
okay. We must correct. Add it, no matter what.
Yes.
Even if we have been given, let us add it.
Exactly.
Does it add marks or something?
Yes. No, it doesn't add marks, but it just shows you have basic understanding of the subject.
Understanding. Okay.
Yes.
Okay. Okay. It's all right. Okay.
All right. Thank you for that question. Yeah, very nice question. Any other question? Okay, everybody's hands are down. Okay. I believe we are having a nice time. I like this interactive section. All right. So what's our 2021 return on capital employed? What do we have? Have we calculated it? I believe we are crunching the numbers. Okay, so let me wait.
Excuse me, sir. Please, can we go back to the formula?
Okay, yeah, I've gone back. All right, that's the formula page. I'll stay here.
It has not reflected. It's my head.
Sir.
Yes, please.
I got 9.5%.
Thank you very much. So for return on capital employed,
I got 10.2. I don't know if I'm correct.
Okay, 9.5%. All right. Another person got 10.2. Okay. Any other person? Okay. Is that for 2021, both of us?
Yes,
Yes,
sir.
sir.
Okay, fantastic. All right, so maybe we do the second variant for net assets. What do we get? One that has your total asset less current liabilities. What was your percentage?
Less current liabilities.
Yes, less total assets. The second formula, less current
Oh, okay.
liabilities.
No, I did share capital plus
Reserves plus
non-current
current.
assets.
Yes. So let's do the second one. Yeah, where we have total assets less current liabilities. So the net assets will be total asset less current liabilities.
Um, I think, are we using the first formula or second one?
The second formula that has the denominator as total assets less current liabilities.
What about the share capital? Oh, we should use that.
Yes, you've already given me the answer for the first one, which is you said 9.5% and 10.2, the second person. So you want to do the second variant that has to do with total asset less current liabilities.
So are we on 22 now?
I didn't get that. Are we on what? I didn't catch that, Julie. You said, are we on 22?
22 now. Are you comfortable with that answer?
Oh, your network is cracking. Sorry, what did you say? You say, are you comfortable?
I think I said, should we go calculate 22? Yeah, 22. Should we go for 22? Or we should continue with 21 or calculate it again?
Okay, yes. So let's do 2021, then 2022. We can just take that to our personal assignments at home. So let's just do 21 because of time so that we just move. So I'll do 2020, you do 2021. Let's leave it at that. Then 2022, you can practice that one on your own. So have you gotten the net assets for 2021? The answer?
So I got for the net asset I got 10.4%.
Okay, 10.4%.
For 2021. Yeah.
For 2021. Okay, so let's stop there. So Julie, what do we have? Any other person has a different figure? Salmat, are you engaging? Rufi, are you engaging? I think it's only Aisha and Julie that is working.
I am still doing the share.
Yes,
I did the share. I did the first formula for all of the 3 years.
Oh, okay. Okay, fantastic. That's good to hear. All right, so has Julie gotten her answer? Okay, so have we gotten our answers? Apart from Aisha's 10.40, who has a contrary percentage? Okay, I believe we are still crunching.
Actually,
For the other
10.43.
method.
Sorry, somebody is saying something aside Aisha. Who is speaking? This is Zach. Are you speaking? Okay, I had somebody under the under Aisha's voice. All right, Aisha, come again. You're saying something. Hello, can somebody hear me? This network has now started.
Yes, I can hear you. I think it's her network.
Oh, okay.
He was
okay.
saying that it's 10.4.
Yes, I only have Aisha's figure. Yeah, I only have Aisha's figure. I don't have any other.
Clearly.
Okay, thank you for that clarification. Any other person with a contrary figure?
So I'm getting 9.6. I don't know why. It's just changing.
That's nice. 9.6. Okay, so that's the second option we have. All right, at least I have two people that have commented. So Rufi and Salmat, do I wait for you guys?
Yes, we're almost there.
Okay, all right, let's wait a bit. So I have Julie, I have Aisha. At least let me wait for you people to give me your figures. And thank you, Julie. Thank you, Aisha, for that. So we'll do 2022 on our own so that we can compare the 3 years. You know, the examiner loves that comparison. And for the past 2-3 diets, he has been coming with 3 years, 3 years, 3 years. So let's be conversant with that 3 years financial statement it normally brings.
Oh, please. I think I'm getting something wrong. The net asset is. Oh, okay.
Yeah, so the net asset is your capital employed, which means where net asset means total assets minus current liabilities.
Minus current liability.
Yeah.
For 2022, I got 9.6 as well.
Oh, fantastic. We went to 2022. For which variant, the first or the second?
The second one, that's total net asset less current liabilities.
Okay, 9.6. All right. Okay, fair enough. We're waiting for you. Salmat and Rufi, we are waiting for you. It's good at least we remind ourselves of this number crunching. It's been a while we crunched such numbers.
It's got 10.43.
Okay, that's good. Thank you. 10.43.
Yeah.
Okay, thank you for that. So who is that? Is that Salmat or Rufi?
It's Salmat.
Okay, thank you, Salmat. All right, Rufi, we are still waiting for you.
Yes, sir.
For return on capital employed for 2022, I got
Yes,
nine
please.
point I got 9.77%.
Okay, 9.77%. Fantastic. Thank you for that. That's Aisha, right?
Yes, sir.
Okay, thank you. I need to catch your voice. Okay, so Rufi, we are waiting for you, Rufi and Salmat.
Is Rufi still on the call?
That one year of
It's here.
2022, I got.
Yes, I'm listening. 2022, you got.
Under the share.
Okay, the
Yes,
first
under the
payment.
share capital method. Yes,
Yes,
I got 9.8.
9.8. Okay, fantastic. Thank you. Okay, so is anybody calculating or we should go ahead?
I'm still calculating.
Okay, fantastic. We're waiting. It's almost time for our break anyway. Oh, Aisha's network. Chidima is just joining us. Sorry, we didn't give her updates. Chidima, we are calculating return on capital employed. We've delved into the calculative aspect of the teaching. So we are trying out 2021-2022 financial year of the calculation you can see on the screen. So some of us are doing the computation ourselves. That's why we're waiting for the figures so that we can continue. So that's a brief update anyway on why you are hearing everywhere quiet. We are just crunching numbers and trying to calculate the return on capital employed.
Sir, just I think I heard you when you I came in when you were explaining why preference share is exempted. Can you please repeat that? I'm sorry, I needed to get that clearly.
Okay, fantastic, very good. So preference share is a special covenant or special debt owed. So they are neither long-term debt nor owners or providers of capital. So the share capital, retained share premium or reserves, retained earnings are for the ordinary shareholders, the owners of the business. But bank loan, bonds payable, and every form of long-term debt, debentures, are external providers of capital. So preference share are special because they have a particular amount that is deducted as preference dividend from their from the company's profit. So you don't include preference share capital in the calculation of return on capital employed because of that restrictive covenant. It's called the restrictive covenant because whether you make profit or not, you must give them their dividend.
You must give them, yeah.
Yes.
First to be paid.
Exactly. Exactly. That's why we don't include it.
Okay.
Yeah.
Thank you.
All right. For those calculating, how far, where are we? Are we still crunching?
Yes, for 2021.
Okay.
10.43%, and return on capital employed as calculated, my own calculation.
Okay. Is it for the first or the second variant?
The first variant.
Okay, 10.43 for 2021. Then for 2022, did you calculate anything?
Yes, 10.41.
Okay, 10.4. Okay, fantastic. Thank you for that.
Yes,
So,
for 2022, the net asset calculation is 10.41 to Wimi.
okay. For 2022, 10.44.
Yes. Net asset.
My own net asset calculation for 2022 is 10.45.
Okay. 10.45. Okay. All right. I believe all of us have calculated. Is that all? Any other person? Okay. I believe we have all calculated. All right. So, can we go on the break or let's calculate it and see the actual figure? But what I noted from all our computations is everybody's figure is very close. Nobody has an outrageous figure. So if you can see my screen, I have 9.5, 10.2, 10.4. For 2022, I have 9.8, 10.4. And for the second variant, I have 10.4, 9.6, 10.4, 9.6 for 2022, 9.7, 10.4 and 10.54. So it's very close. The figures are very, very marginal and they are close to each other. So it may be rounding up or there's no outrageous one. Maybe we have 12 or 13 or 15%. So it shows, or I believe all of you are correct in my opinion, but then I would like us to do it so that we can know which is the actual figure. Can we go ahead or we should go on break? It's already time for 10 minutes break. What do we say? Okay, one person say go ahead. Okay, Julie, what do you say? Rufi, what do you say? Should we go ahead,
please? Let's go ahead. Yes.
Okay, 2 people. The rest, are you okay with that? Okay, that's fine. 3 are already agreeing to that. Okay, fantastic. Okay, so from the figures, let's go for our profit before depreciation and amortization. But don't forget, we have to add back depreciation if we go from the profit before finance cost and tax. Take note of what Julie said. So if we are taking profit before depreciation and amortization, that is not what you call it. So we don't take much time. Let's pick the figure direct, like Julie opined, and I agree with her. But under exam condition, be careful with the way the examiner tweaks the question. Okay, so I'll just go and pick the figure. No need to pick the narration. So I have 145,200, and I come and add it here. So I'm just trying to format it as a normal page. Okay, so 145,200. No need to add depreciation and amortization since we picked the figures themselves. Okay, so let's go for the share capital, premium, retained earnings, bank loan, and payable. Pick 5 of the figures. So on our SFP, we go to 2021, 210, share premium, retained earnings, no preferred share capital. So we'll go and pick bank loan and bonds payable. So I've taken the 5 figures. Let me add it here. Okay, so we have a total of 1,672,950 as our total capital, internal and external. You understand what I mean? Okay, so let me pick all these ones we calculated so that we can see who is correct. All right, so we go for our rows right now for 2021. 145,200 divided by our denominator. So we have it as 9%. So who got 9%? I have three options: 9.5, 10.2, 10.4. Who got 9%?
I got 9.64.
Okay, 9.64 is close. Who got close to 9%? 9.5. Okay, it's close too. Any other person? Well, even with this calculation, 10.2, 10.4, I believe his calculator is very close, so you can use it to make your decision. All right, that's nice, Julie. That was nice. Who also got 9.5? Well, I would say all of us are correct. So let's go for
9.5.
Okay, 9.5. Good, fantastic. Fantastic. Even those that got 10 is close, so it's the same. It's almost the same thing. So let's pick for 2023 profit before depreciation and amortization, 166,980. So let's pick that 166,980. Okay, so we have that. Then let's go and pick our liability items. So we have 1, 2, 3. We have bonds and we have 5 of them. So I'll pick them. Okay, so we have a sum total of 1,709,663. 1,709,663,000. So our total. Oh, I think I'm getting something wrong here. Okay, it's the formatting. I picked the figures to the wrong places. So I pick 166,980 here. Pick this here. Okay, so our total liability amount is 170. Okay, so let me take the options we all have here. So our return on capital employed will be 166,980 divided by 199,230, 238. No,
it's 170.
Yes, 1,709. Yes, thank you for that. Okay.
663.
So we have the total as 9.77, but approximately 10%. So as I approximated, it's 10%, but it's 9.77. So somebody got 9.8, which is correct. Who said 9.8? Julie, right?